Hi, welcome to this podcast where I'm going to look at marginal costing and how we use it in accounting. Very much an introduction. We'll be doing some more work on this with the students that I teach. But the marginal cost is the cost of producing one additional item or unit. And the main use in accounting is when we're looking at putting a cost on production and therefore going to use that information to work out a selling price. Okay, some of this is revision for the syllabus that I teach. This is covered in A2, whereas we do the different types of costs in AS accounting. But just a quick recap, we have a fixed cost, and the fixed cost of an item is the costs that are going to be there no matter how many items that we produce. So, for example, it may be that we have to rent a premises, and that premises is going to cost us £100, dollars, or KD, regardless of how many units we produce. You've got your variable cost, and by and large in accounting, your variable cost is also your marginal cost, and that is the cost of producing one extra item. So in this case here, the variable cost is 10. And what that means is that the labor costs and the material costs of this good is £10 per item. And as you can see here, the variable costs, I've put that in there as being the marginal cost. Now, just a little bit here just to explain why there is a difference between marginal cost and variable cost. Some people would put the marginal cost of one unit as being 110 because we have to have the premises to make the one unit. Okay, and then we've got our total cost. That's just your fixed cost, variable cost. And what you can see is that the total costs go up directly in relation to the variable costs once we get to producing one unit and more. So if you just have a look at the sort of diagram here, you've got your fixed costs, which do not change. They stay the same with each level of output. You've got your variable costs, and they increase by the same amount with each increase in output. And your total costs, if you can see here, you've got a nice parallel line for your total costs in yellow. Okay, and just here to quickly show you on a graph a little bit of a difference between the marginal cost. So the marginal cost of producing no units is actually £100. But then once we get beyond the original fixed costs being a marginal cost, then your marginal costs are always the same as your variable costs. And just a quick thing to look at on here, okay, and it's because of the fixed cost, but although your total costs go up with outputs, because these fixed costs are being spread over a larger number of units, what actually happens in a firm is as the fixed costs or as the output increases, the actual average cost will decline. So if you think about something like a car factory, which is obviously very, very expensive to set up, so it has a lot of depreciation and employs a lot of workers, just to produce one car on a production line is clearly very expensive because all those fixed costs just have to be covered by the sale of one car. But as your production increases, those fixed costs are spread over a larger number of units. Okay, so how do we use marginal costing? Well, the first thing to bear in mind, when we're doing marginal costing, we are going to ignore those fixed costs. So here we have a product which is being made. And for now, we'll ignore things like the rent and any costs of a manager, which would be a fixed cost. And what we're going to do is just look at the marginal cost. So here, somebody's come along and they've offered a new order of 50 units, but they're only offering to pay $17. Now we know it takes 2 hours to manufacture. So that's going to cost me $10, 2 lots of 5, and it's going to use 3 kilograms of material. The material is 2 kilograms per item. So my total cost of production is going to be $16. And certainly on the face of it, you would say, well, at least we're making more money in revenue than it's going to cost us. We would say here that the contribution, accepting this order, is going to be $1 per unit, and that's because we've done the selling price, take away the cost, and that's how much better off we'd be for accepting this order than not accepting the order. Now, that for marginal costing says purely on a finance point of view, this would be an order that we ought to take as a business. Now, there is a counter argument to that. If we look at all the costs of production, okay, so if we're looking at all the costs, the marginal costs, the variable costs don't change. But for this business, they plan to sell 20,000 units and the rent is going to be $20,000 per year. So for every unit that we make, we need to cover $1 of rent, and the manager's getting paid $10,000 a year. So we're also going to need to cover 50 cents of manager cost. And therefore, the counter argument, if you like, is that really the real cost of production for this particular item is $18. And therefore, if we sell it at $17 and sold all our production at $17, then we would never ever make a profit because we wouldn't cover all of these costs for both rent and the manager. Okay, so there are problems with marginal costing. Things that we need to consider, for example, is there going to be an impact on existing customers? If all my existing customers who are purchasing goods at the planned selling price of $20 find out that we're selling to some people for only $17, are they going to accept the same prices? Will we ever generate enough contribution to cover all of our fixed costs? We'll cover some more advantages and disadvantages. Okay, but the one of the big advantages of the marginal costing is that we don't need to revisit our fixed costs every time we get a new order in. So it's something we can do very, very quickly throughout the year. And what it should ensure is that any orders that we do accept at least generate some additional contribution towards covering those fixed costs. Right, for those of you that I teach, there will be some questions on our Google Classroom. And thank you very much for your time. And any questions, if I teach you, obviously feel free just to drop me an email.